And welcome to Inside India. I'm JP Ong. Here are your headlines. No signs of a slowdown in the AI momentum as OpenAI turns to Amazon in a blockbuster cloud service deal, with Microsoft also pouring billions of dollars to the United Arab Emirates as the battleground to develop AI grows.
One of the key things that we are doing together with G42 is not just growing the use of AI for this country and this region, but really all the way to Singapore, to India, to Southern Europe.
Earnings are front and center for the Indian markets. Plus, Morgan Stanley is sounding bullish about India at the HKMA Financial Leaders Summit, saying it will be among the most widely held markets in the next decade. And speaking of the HKMA Summit, Emily Tan is on the ground in the thick of things out there in Hong Kong. Emily?
Thanks a lot, JP. And it is the who's who in the global financial world here attending HKMA's 4th annual summit. And we're going to be speaking to Paul Chan, a Hong Kong financial secretary, coming up on the show.
And a good Tuesday morning to all of you. We start off once again, as usual, taking a look at how Asian markets are trending in their morning session, and more red than we've seen in the previous day, actually, with most markets giving up some ground. Japanese markets coming back online after the extended holiday, but in the red after Japanese PMI figures pointed at manufacturing contracting manufacturing, that is, activity in the world's 4th largest economy. They're not the only ones posting contracting PMI figures. The U.S. also showed that their manufacturing activity also contracted for an 8th straight month, and perhaps just issuing some color, at least some color, and perhaps just prompting a little bit more risk-off appetite in Asia, as well as questions over the world's largest economy grow once more. The South Korean Kospi among the leading laggards today, down by more than 2%. Meanwhile, seeing Shanghai down by about 0.25%, while Hong Kong is holding on with the gains of just about 0.1%. And as always, the Indian markets also set to come online in about 43 minutes. And let's take a first snapshot of how what GIFT Nifty futures are perhaps foreshadowing today. And we're seeing that it is looking a little bit more optimistic, though less than some, about just about 100 points above the close yesterday. Keep in mind the Nifty 50 did close Monday in the green, but did break out of 2 straight days in the red, actually. Meanwhile, the Indian rupee also continued to soften once more. 88.74 is where the local currency now rests against that U.S. dollar. And as we mentioned, we are watching for some mega earnings today out of India. The country's biggest lender, State Bank of India, reports today, with other big companies to look ahead to, such as Mahindra & Mahindra, Adani Enterprises, Indigo, Paytm, and Indian Hotels. Remember, over 400 Nifty companies are announcing Q2 numbers this week. Markets are also busy with IPO activity this week. Billion Brains Garage Ventures, the parent firm of stockbroking platform Grow, opens for retail subscriptions today. Ahead of the retail bids, Grow has already raised almost $340 million from anchor investors, including the sovereign wealth funds of Norway, Abu Dhabi, and Singapore. The company is reportedly seeking a $7 billion valuation through the IPO, which would make it the biggest listing ever in India's brokerage space. Meantime, eyewear retailer Lenskart's IPO was sold out in 5 hours across investor categories, including retail buyers last week. The offer closes for bids today, and we'll wait for the final subscription numbers. But there are questions around valuation, with Lenskart jumping from about $1 billion in July to nearly $8 billion just this week. And as we talk about all the buzz from earnings to IPOs, CEO of Morgan Stanley, Ted Pick, weighed in on the Indian markets a few minutes ago at the HKMA Leaders Summit. He said India will be one of the world's most widely held markets over the next decade.
India has enormous infrastructure-led runway, will be one of the world's most deeply held markets once we see the kind of deregulation that we would expect over the next 5, 10, 15 years. So if you think about the next 5 years and we talk about the need to diversify as between risk and non-risk assets and between public and private assets, it really does matter now to have that geographic footprint in all 3 major locations. Very different narratives, but all should generate alpha and positive risk-adjusted returns over the next 3, 5, 10, 20 years.
And also focusing on Indian manufacturing, a private gauge shows India's factory activity picking up in October, driven by strong domestic demand, even as export growth cooled down. The HSBC India manufacturing PMI rose to 59.2, up from 57.7 in September, signaling a solid expansion. Output growth accelerated to one of the fastest rates in about 5 years, supported by new orders, efficiency gains, and tech investments. But export orders grew at their slowest pace in 10 months. Despite input costs easing, firms continued to raise selling prices at the fastest rate in nearly 12 years, passing on higher freight and labor costs. Hiring increased for the 20th straight month, and business sentiment remained upbeat, backed by GST reforms and strong demand. Meanwhile, a Goldman Sachs report shows India's debt-to-GDP ratio has remained relatively stable since the global financial crisis, except for a brief surge during the pandemic. Goldman Sachs estimates that the country's total non-financial debt is at about 165% of GDP as of the end of the fiscal year 2025, up only modestly from about 157% in 2012 and rising at a slower pace than global debt levels. The report also notes India's government debt remains elevated compared to other BBB- rated economies, leaving limited but gradual room to borrow more, ideally for productive investment to lift per capita income. And Kenneth Ho is the Chief Asia Credit Strategist at Goldman Sachs and joins us now to talk more about these findings and how this might be informing Goldman Sachs' own credit strategy when it comes to the Indian markets. Kenneth, thank you much for joining us today. The picture painted by Goldman Sachs is quite clear. You've got strong and steady GDP growth coming from India, low inflation, decent household debt levels for a consumption-driven economy. But how is this supporting the overall corporate credit outlook for Goldman Sachs in India?
So we think one of the key ingredients in terms of sustaining India's growth and reaching its potential growth in the coming years will be to increase the investment to GDP ratio. And so that we think necessitates a little bit more investment by the private sector. And so we think going forward, there's, as you mentioned earlier, there's moderate room for India to increase its leverage. And one key part of that is the funding of the corporate sector. So we do see a multi-channel approach, from the banks, from the shadow banking sector, from also both the domestic bonds as well as the US dollar bonds. We think those could be funding channels that will become important to funding corporate India going forward.
Kenneth, let's talk about the overall level here because it is at about 156% of the country's GDP. Is there a need for India, or perhaps an argument that India might actually need to deleverage? Because when I'm seeing this, it almost indicates, at least on the top line, that 156% means they're borrowing more than the output actually is than the output that's actually coming out of India. Talk to us about why we shouldn't be too worried about the fact that we're seeing debt above total non-financial debt above GDP right now.
I think if you look at the non-financial debt to GDP level, India is broadly in line with the rest of emerging markets. So it's not particularly high or particularly low versus other emerging market sovereigns. Now, within that, we do see from the government borrowing level, they are relatively high for BBB rated sovereign. So the government, we think, don't have as much room, and clearly there is a focus on fiscal consolidation from the government side. On the household side, the household leverage has risen quite noticeably in recent years, and we don't think the household leverage is going to be the key driver going forward. But what we've seen from the corporate sector is actually the corporate balance sheets have delevered over the last decade or so. And so that's where we see the growth potential. That's where we think a little bit more leverage could help in the investment that we were talking about earlier.
All right. So again, and it's fair to point out also that household debt levels nowhere near the likes of Thailand and Malaysia or even China for that matter, and also corporate credit growth coming in quite reasonably, or a rational growth at least in corporate growth. But again, these government debt levels, you've hinted at fiscal consolidation efforts. Can you help elaborate why this is going to be important for India and how much and why this actually will be a good thing for the overall credit environment there?
So we do think that the government have spent quite a lot of the spending in the last few years on infrastructure, and they're looking to hand the baton over to the private sector, to the corporate sector. And we do think that if you look at the the government debt to GDP level for other BBB rated sovereigns, India is actually towards the higher end. And so that's why we do feel that not going too high on the sovereign level is certainly the right direction, because if you look at comparables, they are relatively high versus other sovereigns. But then the corporate sector is where we think the leverage is relatively healthy and has room to grow.
Okay, so again, shifting from government spending towards more of the private sector driving credit growth in India. One thing that also was notable here is that we've noticed that private sector credit is growing for banks. But again, more and more of it is actually coming from non-bank financial companies. How is this shaping the growing capital market in India, and also overall, once again, supporting this outlook of perhaps optimistic growth for Indian credit markets?
Yeah, so we do see a multi-channel approach, because if you look at how corporate India have been funded historically, bank loan used to be by far the biggest, and the importance of bank loans have reduced over the past decade. Part of this is from the deepening of the domestic corporate bond market. Part of this is from the non-bank, the shadow banking area. And also, we've seen a kind of relatively steady contribution from offshore bonds in the US dollar bond market, both investment grade and high yield. And we think going forward, this multi-channel approach makes sense, because you are looking to supply different parts of the corporate sector using different vehicles through different channels. And we think that really could help in terms of the investment profiles. And also, you have different types of companies with different risk profiles that matches the different investment needs from the various channels, rather than solely relying on the banking sector. So we do think that having a broader set of credit markets and credit supply is helpful in order to fund corporate India.
All right, Kenneth, you brought up a while ago shadow banking, and it does bring up the idea, whenever I think about shadow banking, I think about some of the lessons learned from China's efforts to try and at least modernize and perhaps reform their own banking sector. Now, one thing was interesting from this report also is that you said that there are lessons to be learned for India from China's growth story and the lessons from the last 10 years. Can you talk to us about why it's important to compare the growth trajectories of these two countries and what India can learn from China?
So the growth in China, and part of that is also credit and leverage driven, have had very positive impact on the Chinese economy. You look at the poverty alleviation, the improving standard of living, the becoming a manufacturing powerhouse, and all of those points. However, we do think that there's a couple of important takeaways that would be helpful when thinking about it from an India context looking forward. So the first one is in terms of asset bubble. So we did have, after the global financial crisis, one of the largest credit booms recorded in China. And as part of that, that also helped to drive elevated asset prices, most notably in the real estate sector. And that downturn over the last 4 to 5 years have been a massive drag on the Chinese economy, and in the next few years will continue to be a drag on the Chinese economy. So we think one key lesson there is, yes, we do think India has moderate room to increase its leverage, but it's definitely very important to keep an eye on in terms of trying to prevent an asset bubble. The second important point is, even though China has had this large credit boom as well as the real estate downturn, we've not had any kind of spillover to broader stress in the financial sector. And to a large extent, we think because China has very strong external buffers. You look at the FX reserves, you look at the current account situation. Obviously, China has capital controls as well. And that, we think, kind of provides a buffer in terms of allowing China to work through some of the credit issues over a long period of time. So in terms of how that relates to India, we think it's important that India's external strengths are also maintained.
Yeah, kind of interesting you bring up asset bubbles, because when I think about it, it's not just China. If you look at the history of Japan also, an asset bubble is what pretty much brought down growth in that economy and really has kept them in stuck mode for the better part of the last couple of decades. When you're evaluating risks from asset bubbles in the credit space, what do you look out for, and what do you see that might make you pause on the Indian outlook if you start to see this forming?
Well, when we're looking at the credit markets, we really look at kind of a variety of factors. Some of them are on a micro level. Is micro leverage too high? Some of it is on a macro level, in terms of the broader macro, more government level, is the leverage too high? And from a more kind of markets perspective, we also look at some of the technical and the valuation factors. Our valuation too stretch? Is the technicals too strong or too weak and pushing markets one way or the other? And so we look at all of those factors to try and make an assessment in terms of how we think the credit markets are heading. But certainly right now, if we look at India corporate sector, the fundamentals we think are good. We talked about this broad sort of corporate deleveraging over the last decade, which really have put India corporate balance sheets in a pretty good space. And then in terms of the macro leverage, again, we talked about India leverage. It is relatively high versus other BBB sovereigns, but they are going into this path of fiscal consolidation, which should stabilize that macro leverage.
Okay, Kenneth, I'm curious also, does currency risk factor into things you're watching out for? Because while we're seeing positive expectations from India's markets, economy, and also the credit space, I mean, the rupee also flirting with some of its weakest levels on record. Is this something that should be tabled as a slight concern, or is this something that the outlook can actually withstand regardless?
I think that's an important point, and this relates back to our earlier point with regards to external strength. And so, yes, obviously, volatility on the FX will have an impact. But if your debt level are mostly domestic and mostly raised in INR, then that should give you a significant buffer, which also kind of relates to the point earlier. We estimate that over 95% of China's debts are in RMB. So that gives them a very strong insulation. So going forward, we do expect more Indian companies, especially on the high yield side, to tap the international markets. And we think that's going to be an important source of credit provision. But also importantly, they should make sure that the external buffers are strong, and obviously there's got to be significant focus in terms of raising debt in the domestic market as well.
All right, Kenneth, one last question. So it seems that the outlook is good on both sides. Fiscal consolidation might support the outlook for Indian sovereign bonds. We have corporate discipline, actually, and room to actually, and disciplined spending from corporates actually supporting the outlook for corporate. I know that perhaps this is a rising tide that lifts both boats, but do you think that one boat will rise higher than the other based on the outlook? Do you think there's more upside in the sovereign space or the corporate space with regards to the credit outlook in India?
So we've been a little bit more cautious overall on our credit view, preferring more investment grade over high yield, and within the high yield space, we've been preferring more the BB space. Now that's not because fundamentally we think there's any kind of problems. That's really more a valuation call. We just feel that given how tight valuation is, that being a little bit more defensive on investment grade is something that's preferable to us. But from a fundamental perspective, we really don't see huge amounts of issues right now from a kind of regional Asia perspective. If you look at defaults outside of China real estate, has been very, very low for the last 2-3 years. I think this year is probably close to zero. And so the fundamentals are very supportive. It's really a valuation issue, which is why we're a little bit more defensive. But overall, we do think that the macro direction is pretty positive.
So maybe optimism with a hint of defensiveness is the outlook, and perhaps with good reason. Kenneth Ho from Goldman Sachs, thank you again for joining us today and shedding more light on the outlook and the opportunities in the Indian credit space. Well, right now, also at the HKMA Leaders Summit, there's a panel on private equity with the CEOs of KKR, CVC, and Carlyle. Let's take a listen.
Becoming private companies, not just delaying becoming public, but also not becoming public at all. And what's occurred during that period, one, as we all know, is the transformative nature of private capital. It was the complete build out from the early days of private equity to private credit, venture capital, and the full suite of capital tools that allowed CFOs, treasurers, CEOs to actually stay private. And it was the most efficient form of capital, in addition to all the public capital they could get, whether they're dealing in the bond market, et cetera. But it really was just about efficient capital allocation. Along the way, there was a proliferation of private equity firms, and there were extraordinary returns. And if you look at the cycle, all that's really happened over the last couple of years is there was a period of congestion where capital was being recycled very, very quickly. But it's gotten a lot of attention. I actually think at this stage, the narrative is a little stale. If you see what's happening in the industry, the private equity ecosystem, if you think about private equity primary and secondary activity, one of our fastest growing businesses, as you know, is really just in the beginning of creating a more dynamic flow of capital for the entire industry. And I think when you step back, the questions we have to ask ourselves, against the backdrop of a lot of things that have been discussed today, when you think about what's happening geopolitically around the world and some of the big macro trends that we're just living through a huge shift in, going from a deflationary world to a slightly more inflationary world, global cooperation, steep inflection in technology again, the demand for capital of all forms for the next 5, 10, 15 years in the business that we're in is only growing. And everywhere we go in the world, and it was discussed here earlier today, it's about economic growth and economic competitiveness, and the demand for capital will be very high. So I feel quite optimistic. We've taken 4 companies public in the last year, largest privately owned company in Japan, largest private owned company in India, third largest IPO in the United States. The capital is really starting to return to the industry, but more importantly, the opportunity set going forward, because the capital demand is high and we're not seeing a structural change in how companies get capital and how they optimize capital.
That's great. Harvey, you mentioned liquidity there indirectly and speed of recycling capital. Can I go to Joe now, actually? In how do you answer that question from investors? What's your guidance to liquidity? Another statistic that is quoted, Hamilton Lane data on a run rate basis, this industry on the PE side was delivering 23% of your prior NAV in liquidity on an annual basis. That wasn't the case last 2 years. I'm sure you get this question. What's your guidance? What's KKR's guidance for that?
Well, I think context matters here. So it's hard to generalize about the entire industry because I think the bifurcation of performance is quite extreme today and probably more bifurcated than it's been in the last 10 years. I'll give you a good example. I think what's happening now is some of the congestion on the exit side. You really have to contextualize really around what happened in 2020 and 2021 and early 2022. The industry underinvested in 2020 in the middle of COVID. Capital markets were shut, a lot of dislocation, and the industry didn't lean in enough to deploy capital in that window. In 2021, with the response by governments around the world, the massive liquidity that was injected, interest rates going to unreasonably low levels at that point in time, there was a rush of deal making at high prices when there's a lot of liquidity in the marketplace. And if you think about our private equity business, we're holding companies for 4, 5, 6, 7 years, right? Those deals that were done in 2021 at the peak, if you will, at high valuations with a very aggressive amount of leverage because interest rates are so low, those are the deals that are stuck today in the industry. But again, I think what you're going to see, like the firms that are doing well in this environment are the firms that were very disciplined, I think, in terms of pacing of investment in that time frame 4 or 5 years ago. Our deployment in 2020 went up 40% in the middle of the dislocation versus 2019. And our deployment was flat in 2021. Right, so if you look at our US private equity business in the last 5 years, for every dollar we've invested, we've returned $2 of capital to our investors. This year is going to be our big year for Asia liquidity, given the stock markets in this part of the world. Half of our global distributions in private equity are going to come out of Asia, which really speaks to the capital market development in this part of the world you're seeing.
Well, coming up, Indian refiners are snapping up more Russian oil ahead of a U.S. sanctions deadline on oil producers from Moscow. We'll bring you more details right after this short break. Stay tuned. Welcome back to Inside India. We are counting down to the market open in India and a final snapshot or look at how Gift Nifty futures are foreshadowing the open later this Tuesday. We are seeing that they are still forecasting a gain of about 100 points later on above Monday's close. But take a look at the Indian rupee, which has suddenly found room to flex. It is now at about 88.40 against the US dollar, with signs of potential intervention from the central bank RBI perhaps on the horizon for the rupee. Take a look at that 88.43 before the open today. Remember that it was hovering at about 88.74 before we saw the sudden strengthening and solidification, that is, for the local currency, giving back a little bit of those gains, just perhaps loosening up touch, but still 88.41 sees it as significantly stronger than the previous day's close. The Indian rupee at 88.41 against the greenback. And Goldman Sachs CEO David Solomon was also speaking just a while ago at the HKMA Global Financial Leaders Investment Summit. He said there's a good chance of a drawdown in the equity markets over the next 12 months.
If you believe in growth in the world, you have a portfolio allocation as a global capital allocator, and generally speaking, a 10 to 15% drawdown, which, by the way, happens often through, even positive market cycles, is not something that changes your fundamental, structural belief as to how you want to allocate capital. So, when I made that comment at Italian Tech Week about a month ago. I said, and I don't remember how the question was framed, but the question was framed in a way where I said, of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. And I'd say there are very few people in this room that don't think that that's a meaningful possibility. It doesn't mean that the general direction of capital flows, investment, portfolio allocations changing. It just means things run and then they pull back so people can reassess.
And OpenAI's free one-year plan of ChatGPT Go rolls out in India today. Rival Gemini 2 has announced a free 18-month plan for the users of Reliance Jio. And in a major development, the ChatGPT maker signed a big deal with Amazon to run on AWS cloud services. That announcement giving a pop to Amazon's shares overnight. CNBC's Mackenzie Segalos has more details.
OpenAI is teaming up with Amazon for the first time ever on compute in a $38 billion deal that makes AWS the newest hyperscaler to power ChatGPT. Now, the partnership gives OpenAI immediate access to hundreds of thousands of NVIDIA GPUs across U.S. data centers, with AWS set to build dedicated infrastructure for OpenAI's future models. Amazon's VP of Compute and Machine Learning Services told me that the capacity is already live, ramping quickly through next year, and powered entirely by NVIDIA, not Amazon's in-house Trainium chips. Now, this contract was months in the making and marks OpenAI's first major infrastructure deal since Microsoft's right of first refusal expired last week, really clearing the way for CEO Sam Altman to sign with Azure's biggest rival in the cloud wars as Microsoft and Amazon go head-to-head for AI dominance. Now, for Amazon, which just hit a record high and is guiding to roughly $210 billion in Q4 revenue, it is a marquee win, proof that AWS can power competing AI labs like OpenAI and Anthropic simultaneously. And for OpenAI, which just met all the prerequisites to close a $40 billion funding round, it underscores how capital-intensive this AI boom has become, with nearly that same amount now going toward its AWS compute alone, plus a $250 billion commitment to Microsoft Azure. In total, OpenAI has lined up more than $1.4 trillion in infrastructure deals as the race for AI capacity goes into overdrive. For CNBC Business News, I'm Mackenzie Segalos in San Francisco.
And as you can see from those straps underneath, we do have a fresh announcement or breaking news from Australia, the Reserve Bank of Australia, the central bank down under, actually keeping rates unchanged at about 3.6%. That is the cash rate that has been left unchanged as widely expected by economists surveyed by Reuters and Refinitiv. It is a unanimous decision from the policymakers out in Canberra, actually at the RBA. And based on on some of the commentary, they have said that inflation has recently picked up in Australia as well as the domestic economic activity. However, However, they're still seeing quite an uncertain outlook. It also took note of the fact that the labor market conditions remain a little bit tight actually in Australia. But so far, because of the uncertainties, perhaps it was more prudent actually to leave rates unchanged at 3.6%. But as you mentioned, this is widely in line with what markets were actually expecting from monetary policymakers down under. The RBA keeping the cash rate at about 3.6%. And let's get back to the tech story, though. Microsoft is also expanding its footprint in the Middle East, spending about $15 billion in the United Arab Emirates by 2029. Microsoft took a minority stake in Abu Dhabi's G42 last year, and U.S. lawmakers had previously raised concerns about that firm's connections to Chinese tech. But the White House, under both the Biden and Trump administrations, have given Microsoft the all-clear to export some of its most advanced NVIDIA processors to the UAE. Microsoft President Brad Smith spoke to CNBC's Dan Murphy about this latest investment and plans of ramping up data centers to other regions, including that of India.
And I think one of the key things that we are doing together with G42 is not just growing the use of AI for this country and this region, but really all the way to Singapore, to India, to Southern Europe. There is an opportunity to build data centers here, putting together the kind of trust architecture that's needed, and serve a population that really has multiple billions of people.
And you can catch the rest of that interview with the Microsoft President Brad Smith on Access Middle East. Let's take a quick check of oil as well. We're talking about the Gulf regions. We wait for some of those crude futures coming up. You are seeing that there is a bit of a pair down now for crude, for both WTI and Brent crude. Brent crude now averaging about $64.74 per barrel. Meantime, according to preliminary ship tracking data, India's imports of Russian crude oil ticked up slightly in October, despite mounting pressure from the United States to curb their purchases. Kepler data showed India importing about 1.48 million barrels per day of Russian crude just in October, up from 1.44 million in the month of September. However, imports are expected to ease from November onwards after the United States imposed sanctions on Russia's top oil producers, Lukoil and Rosneft, giving companies until November 21st to wind down their transactions. The sanctions prompted Indian oil refiners, including Reliance Industries and Mangalore Refinery, to halt new Russian crude purchases and explore alternatives in the spot market. Reliance has since bought millions of barrels from the spot markets, while Mangalore Refinery reportedly secured 2 million barrels of Abu Dhabi's Murban crude to replace Russian supplies in December. Meantime, along with those Russian oil purchases, additional fees on H-1B visas has also emerged as a point of friction between India and the United States as the two sides negotiate a trade deal. But former RBI Governor Raghuram Rajan says there's an even bigger concern than tariffs or visa fees. He told a domestic media platform that the proposed HIRE Act, which seeks to impose tariffs on services, could be a far more serious issue. The bill is still being debated in the U.S. Congress, though, but services are one of India's largest exports to the United States, with New Delhi shipping $41.6 billion worth of services to the U.S. just in 2024. And India's Enforcement Directorate has frozen about $853 million in properties linked to companies of the Reliance Anil Ambani Group as part of a money laundering probe. The action is tied to loans taken by Reliance Communications and its affiliates from Yes Bank between 2017 and 2019. ED alleges 136 billion rupees in funds were diverted and laundered through a network of shell companies, calling it a fraudulent diversion of public money. The agency has also restricted transactions on multiple residential and land assets in Mumbai, Delhi, and Chennai, including the Ambani family residence in Mumbai. Interestingly enough, in the last 5 years or so post-COVID, the best performing stocks in the Indian markets have been of the companies with relatively low accounting quality. Martin Sung put that question to Saurabh Mukherjee of Marcellus Investment Managers earlier this morning, and here's what he had to say about this phenomenon.
What we've had in India post-COVID is a massive retail boom. So around $20 to $40 billion each year for the last 5 years of retail money has poured into the market through local mutual funds. And in the first couple of years of the post-COVID era, at least, we had very strong earnings growth. So 2022 and 23, strong earnings growth, plenty of retail money coming in. I think that's what underpinned the boom in real estate stocks, power and infrastructure stocks, metals and mining, road construction companies. And that's where I think this accounting anomaly has sort of kicked in. Companies with very strong interface with the regulatory ecosystem and with low cash flows came in, strong growth, lots of retail money, and we ended up with a boom where mid caps, especially small and mid caps with weak accounting, did well. But I think that's pulling back. In the last 12 months or so, as the economy is cooling down, as earnings growth is cooling down, we're seeing high quality companies with better accounting making a comeback.
Well, coming up, we will have more from the HKMA Leaders Summit right after this short break. We're back in 2 minutes. You're still watching Inside India.
Thank you so much. Thank you.
Thank you very much, speakers.
Well, let's get back to the Hong Kong Monetary Authority's Leaders Summit. And given it's a Leaders Summit, we've been hearing leaders from the world of finance all morning. Our very own Emily Tan is on the ground leading our coverage from there, and apparently she is not alone. Emily, who do you have with you right now?
It is the who's who in the global financial business world at JP, and we are here at the 4th edition of the Hong Kong Monetary Authority Global Leaders Investment Summit, and a very special guest with me, Financial Secretary Paul Chan. It is a great honor, sir, to be speaking to you here at this annual event.
Thank you for the invitation to be here, Emily.
Mr. Secretary, I want to start with your projections for Hong Kong's economy. I was reading your weekly blog, and you were talking about the economic outlook. We are on track here in Hong Kong to hit the full-year target for growth. This is after Q3 GDP hitting 3.8%. We are a very export-oriented economy, though, and potentially impacted by what's going on with the trade war and the policies there. How is the city here weathering the Trump trade policies?
Well, you know, our economic growth this year so far, pretty good. So we are on track to achieve the 2 to 3% whole year. Export in terms of merchandises, double-digit growth. In terms of services, visitors arrival, another 10% growth compared to last year. Last year we have about 44.5 million visitors. This year even stronger, particularly from the international community. Private consumption returning to stability. Restaurant receipts, private consumption, retails stabilizing. Also, the real estate market in terms of residential also stabilizing. So we are pretty optimistic about this year.
I'm curious to know, given that Hong Kong is such an export-oriented economy, how is it that we've seen this resilience here? What is Hong Kong doing? How is this possible?
Well, on the trade front, we follow the reconfiguration of supply chain and industry chain. As you may have observed, some of the mainland companies in response to the trade war already going abroad to realign their supply chain and industry chain. So we follow them and to provide the related supply chain management services, trade finance, and the other services.
I want to get your take on the Sino-US summit that took place just a couple days ago between President Trump and President Xi. The flow-on impact on Hong Kong, of course, China is navigating this, but what is the impact to Hong Kong?
Well, the recent discussion, the meeting between President Xi and President Trump, I think the market has perceived this pretty positively. It is towards the right direction. And for us in Hong Kong, our strategy is that, well, US, Europe remain traditional but very strong market, very important to continue to engage. But at the same time, we spend a lot of efforts in terms of opening up new markets, opening up new capital sources like the Middle East and ASEAN.
Yeah, I know you were in the Middle East just last week. I'll get to that in just a bit. I want to get your comments on something that we heard from the stage just a moment ago. We were listening in on Capital Group, and he was talking about Hong Kong and China is where it begins and ends, where investors reward great companies. What does that make? How does that make you feel when you hear comments like that?
Well, you know, the capital market, the stock market has been doing very well this year, 30% increase. So far on top of last year, 18%. And the volume gone up almost by double. And in the pipeline of IPO, very strong pipeline. This year, IPO, we're already leading the world. And we are very confident about the rest of the year. But IPO aside, the follow-on financing also very strong. Green and sustainable finance also very strong. Private and asset management as well. You may have heard that some of the global financial institutions expand their footprint here in Hong Kong in terms of asset management businesses.
In terms of those IPOs, a very busy week. This week is 7 listings in Hong Kong. There'll be 4 on Thursday. We're watching Pony AI, WeRide. They're going to be priced, well, they already priced today, so we're going to be watching these shares. But I want to ask you about the Middle East, because you gave us the market a little bit of a hint, says that Hong Kong should see a Middle East company list in the city soon. What more can you share with us?
Well, a Middle Eastern company will be listed this month. This is only the beginning. Last year, the 2 exchanges start to cause listing of ETFs, and the regulators have already signed cooperation agreements in terms of cross-border supervision. So we expect there will be more companies from that part of the world coming to Hong Kong for listing. And it is for good business reasons, because by coming here, on the one hand, they can tap the international capital. But on the other hand, if they are to be included in the Southbound Connect, they will also be benefit from the southbound liquidity. That would provide tremendous support to their valuation as well.
I'm reading that Softcare, which is a Dubai-based diaper maker, passed the listing hearing in late October. So do you think it'll be that quick? Would it potentially be this company that would be listing in Hong Kong in the month of November?
I do think so. This is a good start.
Okay, I know you can't comment on companies specifically. Let's talk about the Hong Kong equity markets. Year to date, the Hang Seng Index is up 33%. We're at a 4-year high. Do you expect this outperformance to continue?
Well, the pipeline of IPO is very strong. And on the other hand, we have observing capital flow, not just from southbound, but also from the international community. Taking a closer look of the investment flow since September last year till now, about half are from southbound. The rest are from US and Europe. And the investor interest in this part of the world is increasing. I recently went to New York and then Washington. The sentiment there about the investment in Hong Kong and the balance of our capital market, and in particular, the tech sector of the mainland in terms of their innovative capabilities, in terms of their valuation, very attractive to foreign investors.
So there is American interest in Chinese tech, Hong Kong tech?
Oh yeah, this is the platform for them to invest into these tech companies and benefiting from the technological advancement of the mainland.
I'd like to know more about the correlation that we see between the Hang Seng Index and the Hong Kong property market. There is this optimism. The two are highly correlated. So would you say that the Hong Kong property market has bottomed out?
Well, these are two separate markets, although they have some interrelations. What we have observed is that our real estate market, in terms of residential, start to stabilize in the past few months. In fact, slightly increased. So we are pretty confident that our residential market should be bottoming up. And in terms of office, recently there are financial institutions, tech companies taking up lots of space in offices. And there are some offices converted to be for other purposes. Say, for example, student hostel. So it is good that this stock of office premises will be absorbed by the market in different forms.
What is the outlook for the property market, given we had just a recent rate cut by the Federal Reserve? Hong Kong moves in lockstep with the linked exchange rate. Yeah. So this should further boost Hong Kong's property sector?
Yeah, as you said, our dollar lockstep with the US. So the interest rate trend would be consistent, but the magnitude may be different. Rate cut obviously will be beneficial to the real estate market, but also good for business environment because operating costs will be reduced.
I'd like to get your take on the developments for Hong Kong as a fintech hub. We heard about the new announcements. There is this strategy plan.
Yeah, 2030. Yeah.
Please tell us more about it.
Well, MA just launched this fintech roadmap. So multiple funds. On the one hand, data, in particular cross-border data, and making data more easily accessible for different users on a consent basis. And at the same time, we improve the infrastructure, say, for example, cross-border payment, and also tokenization, embracing innovation to make financial services more accessible and inclusive.
Hong Kong recently legislated on stable coins.
Yeah.
The expectation, or what we've heard in the market, is that we won't see any licenses until next year.
Yeah.
Are you able to give us any updates on that?
We start to issue license beginning of next year. We want to do this on a prudent basis. So we will issue license only to those applicants who can demonstrate the use of stablecoin is for real economy. And the business model is credible and sustainable. So we will do this step by step.
As I mentioned earlier that you were in Riyadh last week to attend the FII summit there. Yeah. Tell us more about your trip to the Middle East, because I do note that the Hong Kong government makes regular visits there.
Yeah, well, with the effort in the past few years, I think there are a lot more mutual understanding. And also now in Saudi Arabia, they're pushing forward their 2030 vision, massive infrastructure investments, and also the ambition to diversify from oil-related industry to technology and innovation. So going forward, it is not just on the collaboration between the capital markets, but also in terms of technology companies, startups. So I led a delegation there. Many of these companies start discussions with their counterparts in the Middle East, and they will be organizing a delegation to Hong Kong as well in December. So the way I see it is more and more cross-border industry, technology, startup-related collaborations.
Well, that's great to hear, and we're, of course, watching this closer collaboration with the Middle East. I also want to know about the offices that the Economic and Trade Department is setting up also in Riyadh.
Yeah, soon, very soon.
How many offices do you need in the Middle East?
Well, we have one in Dubai, now another one in Riyadh. The Gulf region is huge. So in the other cities, we use consultants. And depending on the progress, there may be one more offices.
Are you able to share where that could be?
Where the potential is.
Where the potential is. So we look forward to hearing from you, Financial Secretary. Yeah. Thank you very much for joining us today.
Thank you, Emily. Thank you for having me.
Thank you for making the time. We've been speaking with Hong Kong Financial Secretary Paul Chan, coming to you live from the Hong Kong Monetary Authority Global Investment Leaders Summit. And it's back to you guys in the studio.
And a fascinating conversation indeed. Thank you, Emily Tan, for leading that actually out there at the HKMA Leaders Summit. Indian markets are online. Take a look at where the Nifty 50 is now sitting this Tuesday morning, and we're seeing that it is flat to the downside for the Mumbai benchmark, just down by a handful of points at 25,751 so far in the first 9 minutes of trade. Actually, take a look at the Indian rupee, though, which might be the story for Indian markets this Tuesday. Actually, flexing at 88.52 against the U.S. dollar. It is stronger by about 0.1%, and again, that sudden strengthening or sudden flexing from the local currency, perhaps on the back of potential intervention actually from the RBI as it tries to keep the rupee from sliding back towards some of its weakest levels on record. So far, the Indian rupee looking quite strong and a bit more bullish, that is, than the Nifty 50, although it is early days for the Indian equity space. Checking in, or early minutes that is, checking in on shares of Bharti Airtel, the telco giant has reported its 6th straight quarterly profit increase. And take a look at that stock surge, now up by about 2.6%. Nothing sluggish about the telco's own stock in today's morning session. It's powered by users shifting to higher value 4G and 5G plans, with net profit surging 89% to about $773 million for the September quarter. Airtel's average revenue per user climbed 10%, helped by a jump in its 4G and 5G subscribers, but millions of Indians still remain on basic 2G services due to cost and digital literacy gaps in rural areas. With the impact of 2024 tariffs hikes fading, telcos are now pushing users to upgrade both Airtel and rival Jio, scrapping entry-level 4G and 5G packs to nudge customers, that is, to pricier plans. Well, that's all the time we have today on Inside India, but do keep watching CNBC, and that's because Access Middle East is coming up next. Have a good morning.